the one thing you need to be careful of is this buyer's agent try and just burn and churn, get you in the door, get you out, in, out, in, out. So I would be very careful of a volume type buyer's agent. I want someone to hold my hand because it is the biggest purchase you're going to make besides maybe your owner occupier. Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data Podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. And today, Jeremy, Q&A, our first one.
Yeah, looking forward to what's on people's minds.
Well, we've been receiving a lot of messages. So if anyone would like us to explore specific topics, send an email through to podcast@suburbdata.com.au or just leave a comment in the comments section and we can work through it. So question 1 from Buzz is Online 2895. Thank you for another stunner of an episode. Already waiting in anticipation for the next one. Can you do an episode using data on what to look at in terms of entering and exiting the property market? So we are going to do this in the future, but maybe we can give our initial thoughts on this. So entering and exiting a market, looking at data. What would you look at, Jeremy, entering and exiting a market?
Yeah, well, at the top level, this is really quite a simple equation, but the devil is in the detail. So at the top level, all you're doing is you're comparing how much is it going to cost me to exit the market. I've got to pay capital gains tax. I've got to pay an agent their commission. I've got to pay legal fees. Then once I've got those sale proceeds, where am I going to go? I'm going to buy somewhere else that's a better investment. So I've got to pay stamp duty. I've got to pay more legal fees. I might have to pay about a buyer's agent their fee, whatever you've got to pay to get into the market. So those are called recycling costs, or it's a reallocation of your equity from where you currently are to where you'd like to be. And then you just offset those costs against opportunity costs, which is what am I missing out on? So by holding on to perhaps a dud property, instead of investing in a better location, what's the difference? That's the opportunity cost. That's what you're missing out on. If the opportunity costs exceed the recycling costs, then the argument is to trade, to sell and then buy elsewhere. If, on the other hand, your reallocation of equity costs exceed your opportunity costs, then sit tight.
Well, I've seen a lot of investors that have held properties that have underperformed, either had no growth to minimal growth or even negative growth. Just it's more that sunk cost bias where you're holding on to an asset thinking, okay, well, I've injected a lot of time, a lot of money, I'll just wait for it to grow. But you have to look at it from the other aspect of where can I get growth potentially elsewhere? And it is that time injection early to sell the asset, but sometimes you need to cut your losses.
Yeah, but there was also the case where someone might have held a property for 10 years and it hasn't budged, and it might be right on the cusp of the next decade surging in growth. So it's something that has to be examined on a case-by-case basis.
And when you might potentially talk to an expert or someone in the industry saying, oh, just hold a property, you have to ask them, well, why? Why should I hold on to this property? Show me the data.
Yeah, long term, if you hang on to a property, it does tend to cover over a multitude of ineptitude, but the longer you hold a property, the more likely it will have the same growth as the long-term national average. So you're not getting ahead.
So we will explore this one in a full episode. Let's move over to the next question. So thank you, Buzzies Online, for that one. We've got Sandy at Sandy10 Numri, I think Numri. So is it better to avoid a suburb with too much competition? I like this question a lot. I failed to purchase a property in the last 3 to 4 months because properties in all my shortlisted suburbs were receiving like 20 offers and people paying more than 50K over the asked price. So typically this would happen in a heated market.
Yeah, one in which demand is clobbering supply. And I get clients asking this question all the time, Jeremy, I can't get into this market. It's too hot. Is it better to avoid such a suburb? Well, the way in which I address this is I suggest they look at the polar opposite. What if you were to get into a really cold market where there's no competition, where everyone is able to buy under fair market value? That would be a disaster area. That's where prices are possibly in free fall. So although it is, sort of tough advice to say, hey, just dig deeper, spend more, that is the definition of capital growth. The definition of capital growth is when most buyers are paying more than fair value for property. I would much rather pay $50,000 above fair market value, which in 6 months' time looks like I got a steal, than pay below market value and in 6 months' time looks like I paid too much.
And I think you can open up potentially more markets. So we don't know from this question how many shortlisted suburbs are there. Is it only 2 or 3? Maybe you need to potentially look at more markets. Could be 10 suburbs, 15 suburbs. Maybe it might not be in one local government area, but it might be, we'll just use this as an example, it might be in Adelaide and Perth as an example, potentially. But again, that takes more time.
More effort in research, yeah. But you want to give yourself a few options so that when something does pop up, you place a lot more offers, you're going to get a bite sooner or later.
And I think this is where you need to move quite quickly in a heated market. Properties can be listed the same day and already be under offer the same day.
Yeah, and in those sorts of markets, I would advise investors to start off treading cautiously, and then once you've seen how hot the market is, you'll get an idea for how quickly you need to respond, how much above the sort of asking price you will need to offer, how free of conditions your offers need to be in order to get into that market.
Good question. Next one.
Yeah, great question.
Let's have a look. So we've got Eric Lee Pollard, I think I pronounce it, A275. I'm on the fence whether to use one. So this must be a buyer's agent. I'm not having much luck. Analysis paralysis, but is it worth it for $16,000? I don't buy the financial freedom sales pitch they lay on. Am I wrong? Advice.
Yeah, well, I think that if you get the right buyer's agent, they are definitely worth it. Especially, it's interesting that this question has popped up just after the previous one where an investor struggled to get into a market. If the buyer's agent is operating in that same market, they can get in because of their contacts in the industry. So there's a great opportunity to just sit back and relax and let them do the hard yards. On the other hand, if you engage the services of one of the old school buyer's agents, it's always a case of just buy close to the CBD in one of these investment grade so-called blue chip suburbs. Sort of a lazy approach. They're not going to try and get into a tough market.
I think it can be, from my perspective, you can have a good accountant or a not so good accountant. Same with a mortgage broker, doctor, physio, dentist, personal trainer, whatever it might be. So what's your time worth to you? Because you can do a course, you can learn yourself. It's taken us years, over 20 years of experience, seminars, books, just experience. And it's hard to just do potentially like a course and learn really quickly comparing if you're trying to compete potentially with a buyer's agent. But the one thing you need to be careful of is this buyer's agent trying just burn and churn, get you in the door, get you out, in, out, in, out. So I would be very careful of a volume type buyer's agent. I want someone to hold my hand because it is the biggest purchase you're going to make besides maybe your owner occupier if you do decide to go down that route to build up your asset base. So you need to make sure you build some type of trust with that buyer's agent to move forward because, look, I'm not going to lie, it takes a lot of time. It's not as simple as, what's your time worth to you? And can you outperform a buyer's agent? And if you look at the right data, I believe that you can. So it's a great question, and we'll be doing this as a separate episode also in the future.
Yeah, good question.
Next one, great podcast. Good on you guys. Could you please make a video on how to select a suburb with high growth, cash flow, and low risk? So we do have this on our tutorial page on our YouTube. I think that's the Market Matcher tutorial video that we've got. But as we grow and with the new website, suburbdata.com.au, we will have an updated video on that. But how would you select a suburb to invest in, Jeremy?
Well, I would address the high growth by consulting the demand to supply ratio. Cash flow, well, I'd look at vacancy rate and yield.
Good.
And low risk, I would look at the statistical reliability figure.
I would look at, from the high growth, again, I'd look at the DSR plus score at the time of recording. In the future, it'll be the DSR 3 on suburbdata.com.au. But, we want the highest probability of growth that we can have from when we're about to invest. Cash flow, yield and vacancy rates. And then I think the low risk part is the statistical reliability, but the other one is also maybe the infill risk. Are you close to land or supply in those areas, and potentially ABS data that you can sort of look at too online?
Yeah, infill risk is an easy one to do. You just get out your Google Street Maps and see, are you near a vast tract of vacant land?
And then the other thing is, if I am honing in on certain suburbs, I'd be also looking at those block sizes, going for areas potentially with those higher block sizes, potentially opportunities in the future to subdivide, or there might be more options depending on the zoning. So that's how I would hone into those suburbs once I shortlist.
Yeah, that's asset selection. Once you've got your suburb, you're looking for highest possible land to asset ratio, which is high value land, not so high value dwelling on top of that land.
Great question. Next one. So, hi team, as this is from Skynet 1506, but hi team, as houses are increasing in value and becoming less affordable for first home buyers, could you do a podcast on alternative properties such as duplexes, townhouses, units, in brackets, high density, apartments, low density? Thanks. I think we could do something like that potentially.
Yeah, so you've got this problem with how do you get into the market if it's really expensive? What if you go for cheaper property types like units? My opinion would be, based on historical data, houses outperform units. So I think you're sort of selling yourself short if you go for a unit specifically, but I don't think duplexes are too much of a problem, or even townhouses in some circumstances, as long as they've got a decent sort of bedroom count which matches the typical houses in that area. And as far as affordability is concerned, I think that you address that with where you purchase. There are going to be good opportunities in some suburbs around the country. You just need to have a broader perspective, a borderless perspective, an open mind about some of these locations. So cheap does not always mean poor performance.
And even if you look at let's say duplexes, townhouses, even maybe low density apartments of some sorts, but if they're newer, you are going to be paying a premium. So I know there's an example recently where you can purchase a house, let's say for around that 1,000 square meters, but in those surrounding areas, really small houses, maybe 1/3 of the size, are dearer. So you're paying a premium for the building, but even townhouses in certain pockets can be more expensive than older houses.
Yeah, I think that another good general rule is to avoid new property because of the faster rates of depreciation. Yeah, so that's a good one to point out.
And then let's have a look. Thanks for that, Skynet. The next one is Liam Wells 4010. So this is a long one, but let's work through it. Hi guys, I love this podcast. I have listened to every episode. Thanks for listening in. I'm 23 years old, looking to get into property investing. Now, I love the fact that Liam's getting
Wow.
early, because 23, I wasn't even thinking about it. Good on him. I think there's great education out there. I graduated my engineering degree last year and have been saving hard to buy an investment property before I purchase a place of residence. Great diligence and I guess sacrifice at 23. Could be traveling, but just head down, working towards that deposit. I plan on purchasing soon as I can. Over my degree, I've saved $75,000 for a deposit. So I think that's in that ballpark for that deposit, which we will have a look at. My HECS has been fully paid by the company I work for. I'm tossing up what to do now. So he's planning on purchasing a place of residence in 3 years. So to move out at the age of sort of 26. So there's a little bit of detail left out of here, maybe living at home. And it's a good way to save money, isn't it? Even for lending. My main quandary is, do I get in now with a low deposit of 65,000 or so and have an LVR, which is loan to value ratio of 85% or more because of my specific circumstances? Or do I hold out until I have a larger deposit? I'm unsure of whether it is more beneficial to purchase early and have a larger growth potential with LMI or purchase later with no LMI. So LMI is lender's mortgage insurance. So it's a premium that you pay to the lenders just for you borrowing potentially more funds.
Yeah, so this is for the benefit of the lender. It covers them for the risk of you defaulting on the mortgage, but you've got to pay the premium.
So let's work through the example. So he's mentioned, just finished off, I'd love to see an example of something similar, showing how LMI is either a liability or has its purpose depending on the scenario. So I've run some calculations. So on an 88%, let's just say loan to value ratio, so we're purchasing a property of around 400,000 that we can see on our presentation, 400,000. So pretty much borrowing about 68,000. So in that sort of ballpark. So if we go down, we can see here that I won't go through all the numbers because we've done this on a previous episode, but the ROI is around 20%, and a lot of it's determined by the capital growth that you'd receive on the property. So if you have a look at the annual cash flow, it's going to be slightly negatively geared due to the fact that the rates are higher at the moment. And again, when rates will drop, then it will most probably go close to that positive cash flow territory. And we factor things in like council rates, insurances, maintenance, fees, maybe a bit of a buffer. But I think the thing is, firstly, to understand, can you afford the negative cash flow per annum after tax?
Right. So that figure of 6,000 a year, that equates to $500 a month.
After tax, so you'd receive some benefits. You call it a benefit negative gearing. You'd get a deduction. So, and then the estimated growth is around 20,000 roughly. So you are really relying on that capital growth. And then you can see here, the profit roughly over that period would be around 14,000. You've provided a deposit of around 68,000. So you just pretty much divide those numbers and that gives you your ROI or return on investment number.
Yeah, 20% is certainly better than having money in the bank, isn't it?
Or a lot better. Obviously, you are taking on that risk, but I think if you're taking a long-term view, as we do, a lot of the time, if you're not trading properties, but to sort of get into the market, I would, me personally, leaning towards that, but I think you have to talk to a broker first. But yeah, there's a couple of bits and pieces that are left out there, but I think I would be leaning towards the higher LMI.
Yeah,
and I'd go sooner too. Would you wait?
I would definitely go sooner. Get into the market sooner rather than later. The other thing there is, he says, I plan on purchasing a place of residence in 3 years to move out at 26. I mean, that'd be great to have a principal place of residence at the age of 26, but I'm wondering whether you would actually be better off continuing to rent, and instead of purchasing where you want to live, rent where you want to live and then own in the best investment location that you can find. It's got probably a higher yield, better capital growth potential. What are the chances that the ideal investment location just happens to be where you also want to live? Highly unlikely. So I would continue rent vesting. I wouldn't aim for a principal place of residence.
Well, we don't know where Liam is looking at. So like I have a bit of a different approach to this. I would think that, okay, if I want a place of residency, I want my owner occupier, there are benefits around that. But the big one is you might want to live there long term. It might be a house somewhere and you're planning your future there. So I would think of it as a bit more of a lifestyle. It's not all about trying to get that best ROI possible. It's a matter of, if I've got that 3-year horizon, how much is that property in today's dollars? Is it 600,000? Is it $1 million? Because if you buy an investment property now, it might stop you from purchasing your owner occupier in 3 years' time. So you have to do your numbers. So what's your current savings rate at the moment? Are you saving it $500 a month, or are you saving it $5,000 a month? So, are you going to have an uplift in your income? Are your expenses going to increase? Are you going to take time off work? So there's too many variables from this question that we can't answer. But they're the two things I'd be looking at. If I am going to purchase now, is that going to stop me from purchasing my owner occupier in the future? If so, you might need to drop that price point of that investment property that you're going to be targeting early, because the risk is I buy that investment and it doesn't grow in 3 years, and I'm holding on to this asset that's not growing, and now I can't buy my owner occupier. So it could be a matter of, okay, if I do really want my owner occupier, maybe target that first and then work off the back of it. Because I've seen people make the mistake before. Need to buy investments, they start a family, I want my owner occupier now, but they've leveraged so aggressively that they've got to sell and they're stuck. So it's just a bit of strategy and planning in this scenario.
And yeah, it sounds like you would need to know, gauge from their perspective, how important the lifestyle choice of living in their own property is. But purely from a financial perspective, rent vesting would be best, but then you've got to enjoy your life.
That's it. And then you might not want to move around a lot. You want some stability. You want to build your future. So it's just not all about a numbers perspective.
And what about the LMI?
LMI, yes. So the LMI there'd be a small fee associated with that. So in this example of $4,000, again, you need to talk to a mortgage broker about this. But let's say it's around that $5,000 mark. I've used the calculator, and that just gets rolled up into the loan. And you can talk to your tax accountant. But typically that LMI, if it's for investment purposes, can be claimed over a 5-year period. Right. But it's capitalised in the loan, so you don't really feel it. And I've used LMI in the past. I think you have also.
Oh, yep. Yeah, so he's asking whether LMI is a liability. I think it's a good leverage tool.
I think it's a good leverage tool also. And you get to keep your buffer also. So why inject less cash? Because in the next example, if we look at that $400,000 property, now you need $100,000 to purchase that property. So that's not even within his window, because you need to inject more cash.
That's without LMI.
That's without LMI. And you can see now your ROI has dropped because
20% down to 15%.
15% just for the fact that you're depositing more equity.
So yeah, pro LMI, and move in, buy sooner rather than later.
Hopefully that helps, Liam. But reach out if you need a bit more of a hand with this. Like we can podcast at suburbdata.com.au, and we can point you in the right direction. Next question. Can you guys talk about self-managed super fund and buying a property through self-managed super fund? As a mortgage broker, we are getting more inquiries into self-managed super fund lending. So I know that there's a lot of, buyer's agent firms out there. They'll ask you, okay, are you ready to buy? They'll sort of lead in with that. Have you got your pre-approval ready? Because they want to get going. But then if you don't and you're not in that position, how much have you got in super? Can you set up a self-managed super fund? So it's just another way to try and I guess, buy a property, but in a different, I could say, tax structure. So what's your, do you have any?
I don't have any comments regarding buying structure, ownership structure. It's not something I've looked into a lot.
So you need to, it's a bit of planning around here, because you need to talk to, I'd say, financial planner, an accountant, I guess maybe the accountant for the setup of the self-managed super fund, but understanding, does it meet your goals to purchase a property? Because I remember years ago, it would have been maybe 7 years ago, I was doing consulting, and one of my clients got spruiked a property. So the financial planner, accountant, they only had around $100,000 in their self-managed super fund, and it really tied their hands. And then there was lending issues, and then they had to inject more cash out of their personal name, and it was just a nightmare. Brand new property. So it's just one of those a perfect spruiker story. But I would sort of say, as a rule of thumb, ideally you want to have around that $200,000 in your super as a minimum, before you maybe talk to an accountant and a financial planner. And then I think we can do this as an episode, but just make sure there's also a bit of liquidity in there. But normally, from my understanding, talking to my broker, I think every bank's different. So the way they look at capacity is, let's say you're earning a certain amount of money, let's say $100,000 per annum. They'll take maybe $11,000 for serviceability, which is 11% of like whatever you're earning. So pretty much your contribution to super from your employment. So I'll take that into serviceability. They'll take into the rent of the property into serviceability. And then also, if you're making your own contributions to super, they can take that into account also if it's been there for a long period of time. So it is another way of, I guess, exposing yourself to more property. There's also tax benefits in it too. So within the super, it's around that 15%, but then you do get a slight discount. It's reduced to around that 10% over if you hold a property for more than 12 months. So it's it's about that. So it is sort of cheaper if you are sort of potentially trading. The other thing with self-managed super fund is they're a bit more expensive to sort of set up and a bit more hands-on. But I think diversification. So one thing I would say about this is just, again, talking to a planner, making sure that you're not purely just exposed to property completely, that you might want to have some money in shares or index funds or just cash, liquidity. They're all important things depending on where you are and how far away you are from retirement. Because it was me personally, I wouldn't be buying all this property, but I'm retiring in a year's time. Put myself under all that risk.
Yeah.
How am I going to pay that debt down? So I think, we can definitely do a big episode on that. But what else did I have on there?
How capital gains works in super?
I think the other consideration was most probably like the liquidity. So, you can't sell a property quickly. Can't sell a garage off, can't sell a bedroom off. So that's most probably the big thing there. But I think we'll definitely do a summary on this in a future episode and give our thoughts. But I think if you are looking to expose yourself, you just need to buy a property in a growing market if you are exposing yourself to this. Actually, I've got a little bit more on the slide. So how capital gains works in super. So again, this is just a slide. You talk to your tax accountant, but I think the main thing there is, or the big benefit is, if the asset's held for more than 12 months, the capital gain is effectively reduced to 10% due to the 1/3 discounting. So if you purchase in your own name, if you've held that property for more than 12 months, you get a 50% discount on the capital gain if you sell. So I think it would work well maybe in a trading scenario, because if you're in that higher tax bracket, you're paying a fair bit of tax, aren't you, in your own personal name? And then there's obviously pension phase. You can talk to a financial planner about. So when you move into pension phase, but again, none of this is advice. You talk to your financial planner and accountant about that. I do have an example here. So if you did buy a property within a self-managed super fund for $200,000 and sell it after 2 years for $300,000, the capital gain is $100,000, and then you get the 1/3 discount. So the taxable component would be around that $66,000, and then 15%, that would equal $10,000. So the capital gain of $100,000 you've made will be taxed at around $10,000. So it's about a $90,000 profit. Obviously, not taking into account entry and exit costs. And then if you sell the same property within the pension phase, that's after like you're in that pension phase. So when you retire, if you're still working, you can get like a part pension or a transition to retirement. But if you do go through that pension phase, then you pay no capital gains tax on the $100,000 gain because it's in the pension. That's a big advantage of super. But as I mentioned, none of this is advice. Talk to your financial planner or tax accountant. Even though I've got an accounting degree, it's just like you can be a tax accountant or you can be a management accountant or a financial accountant. But yeah, I've had a lot of exposure to scenarios like this and seen it with financial planners.
Cool. Good advice.
Finishing off, what is a good yield? I've got one here.
1,000,000%.
So a good yield is, I've just got Sydney units up on the screen. So typically the average in Australia across the board is 4.33%. If you look at Sydney units, this is gross yield. It's 4.04. So I think this can be different for everyone. Like a great yield, like I'd love to get 7, 8, 9, 10%, but I want to be moving into markets that are going to be growing. There's no point in me going into a market with a 10% yield and I'm not injecting, it might not be costing me a lot from a cash perspective, but I'm not receiving any capital growth.
Yeah, if that was the case, ideally you'd want both a high yield and good capital growth at the same time. And that is possible, but it is only short term. Eventually, you cannot have a market where property is positively geared because then it would be just easier for tenants to not be tenants. It'd be cheaper for them to just own. If they can afford the cash flow to pay rent in a positively geared market, they can afford to own a property. So it's usually those sort of itinerant worker places like the mining towns and so on. But you can see there that one standard deviation above average is around about 6%. So beyond that, we're looking at a pretty exceptional sort of range. So most of the time I see that some of the hot markets with decent yields are around that 5-6% at the best. But I certainly wouldn't be worried if it was only 4%.
Yeah, and you might restrict yourself some really good markets if you just purely focus on yield, which I know a lot of investors do. So I would look at it about, okay, well, how much am I saving per month on average over the year? And then it's like, okay, if I purchase a property with a yield of, let's say, 4%, how much is that property going to cost me per year based on conservative numbers? And then you can sort of work backwards from there to go, okay, this is my strategy. I need a 4% yield, but I want to move into a really decent property in a growth market.
Yeah, and another thing to point out there, this is just gross rental yield. And the higher the gross rental yield gets, the net rental yield does not increase by the same amount. So for 4% gross rental yield, you might be paying, say, 1.5% of the property's value in repairs and maintenance, insurance, council rates, property management fees. But if you get up to, say, a 10% gross rental yield, you're not clearing 6% there. You are probably still only clearing maybe 1 or 2% because council rates, insurance, repairs and maintenance, property management fees become a larger percentage of the property's value.
And even like with that 4% that we're looking in this example of Sydney units, you need to take into account strata in the building or if it's in a gated estate. So that can really impact. So even though units might look great, the yield's fantastic. Well, is the property receiving capital growth? I think it's a good example.
Yeah. So what's a good yield?
Good question. Well, again, what's your personal circumstances? I would think that look at the top markets, have your shortlisted suburbs, and then you can work in from there. So let's say I look at a local government area and there might be 8 suburbs I've pinpointed. Maybe I want to start with the higher rental yield areas. That's how I would maybe potentially start shortlisting them. Start them as the top and then start working through, and then have all your alerts set up. Start contacting agents. Good question. So I notice all your content is based upon lending, etc., which is the most common. However, would you consider doing an episode on what's the best way to invest when you don't need lending or something to that effect? You could say you've had someone who has received an inheritance or something, so a large sum of cash potentially, and they ask you what they should do. I think that would be relevant and something most people don't cover. This is a great question. Back in the day, I remember someone called through and they invested in crypto, Bitcoin in the early days, sold off, had a large sum of cash and just wanted to buy a property in cash with no debt, which I found was interesting because on the next slide, the way that I look at it as, if we look at this scenario, it's not 88%, it's 80%. But let's say we buy a property and we utilize lending. Now, we know lending is the key part to property investing just because of the leverage power and how growth can really impact your return on investment. Now, based on, let's say, a 20% deposit, we maybe expect let's just say, a net yield long-term of around 18%, give or take, on our money.
Return on investment. Yeah.
Return on investment. Now, if we move to the next slide with a 0% LVR, so we're pretty much paying for a property
in
cash, your return on investment drops to 7%. If you look at maybe like some of the index funds in Australia or overseas, you might long-term with income and growth receive maybe 10%, roughly 9-10% per annum. So that's why if you inject cash completely, you do limit your ROI potential. So again, if it was in my circumstances, I would take that $700,000 and most probably look to buy 2 or 3 properties in different markets and utilize leverage. One, because I'm getting a bigger asset base. So instead of just having a $700,000 property, I could go maybe 700, 700, 700 and get exposure to roughly $2 million worth of property. But it just depends on where you are in your journey. What's your lifestyle like? So you need to work it in.
Yeah. So what if it was someone who had retired?
Good question. Or it depends on, okay, well, what's your expenses like? How much are you saving at the moment? Do you need more yield? Can you hold on to the property for 10, 15, 20 years? I think if you need to sort of sell within, I know you're going to correct me on this, but like trading, maybe you just buy in and buy out after 4 or 5 years.
Yeah.
But I think it's always good to have maybe that stable property, and then you can maybe spread out your asset class and your wealth. So again, without knowing everyone's circumstances, you can't answer that question.
Yeah, but I think it's a good point and this is a great example of the difference that you get by leveraging in property. The difference between share market type performance versus holding property, it's staggering when you can leverage.
And I think it also comes down to risk. Now, the most common misconception that I hear is it's all about, I'm worried about debt. And I used to be the same, scared of debt. I know growing up, it was like, my grandmother, just buy one property and that's it. Property investing wasn't a thing back then. But the way I look at it is, I've just gone off track here, but like the risk. The risk. It comes down to risk. So a lot of people are scared of debt, but I always look at, okay, well, if I know my employment's secure, I'm saving, let's just say an example, $2,000 or $3,000 a month. It's all stable. I've got a good cash buffer always behind me. Let's say it could be a year's worth of living expenses or 6 months worth. I'm okay taking on that risk, because the big risk is you're not going to receive that capital growth. So in this example, if you go 700 on that one property, you're really relying on that market to grow. Where if you buy 3 in 3 different markets, you've got exposure.
Yeah, you've got that diversification.
You've got that diversification. So this is where I would sort of, again, we've talked about it, but I would sort of spread that risk out.
But that's, of course, assuming that you could get the lending.
Exactly.
But if you can get the lending, you'll definitely be more profitable.
Well, that's a good point. So let's say you're only working 1 or 2 days a week and you can't get the serviceability. So you've got all this cash, but the thing that's holding you back is, can you get that serviceability? So the way I would look at it is you sit down in front of a broker and work out, okay, how much can I borrow? And they might say, look, you can't borrow much, but I would try and utilize as much lending as I can and keep that cash as a buffer. Like, I wouldn't want to put $700,000 down. I'd rather put, let's just say, $300,000 down potentially in that $400,000 loan and just keep the $300,000 in the offset as backup money to enjoy my life.
Yeah. And there used to be these low doc loans and no doc loans in the past. So if you had a wad of cash, you could get funding regardless of your ability to service, simply by having a very low loan-to-value ratio. I don't know what the situation is now in the mortgage broking world, but that was one option.
I really like these scenarios, just sort of working through it, but you just need the whole picture. It's just a strategy and a plan, really, isn't it?
Yeah, well, you've been through an enormous number of them. So you've probably seen it all.
But if anyone wants, they can send their questions through comment section or podcast at suburbdata.com.au. Now, Jeremy, just some updates. So we recently hit 1,000 subscribers. How do you feel about being a global superstar? It was a joke.
1,000 subscribers. Yeah. Oh, that's great. It's more the comments that I get rather than the numbers. There's some people that just really say some very encouraging words, and it just makes me feel good.
I want to do a bit of venting, but it's just I've got a bit of frustration around, I guess. I see property investing. I think it should be more about collaboration, I believe. And I feel like, look, there's been things in the past where I'm seeing more and more in the industry where I feel like it's just, I don't know, what's in it for me? Like that sort of mentality where I think we really just want to put out really good content out there. And I won't mention, should I mention my frustrations or not?
I'm curious now.
I know that you recently went on a podcast recently. And look, I wasn't happy about it. Like I thought you were going to be on the main channel, and then I realized you were on the secondary channel. And your time is very, very. It's valuable. It is. Like we've got a lot of work. Suburb Data is almost live. Suburbdata.com.au. And I guess I was just really frustrated because I see you on the secondary channel, and I wasn't too impressed. And the worst thing was, you didn't even get offered a coffee. I'm venting it. I'm just saying.
That's the worst.
I was just, think about other people. It's just my frustrations really, really, I just get agitated. I try and let things go, but I just needed to vent it on the podcast.
Okay.
Moving on, our Suburb Data progress. How far are we away? So it's
always 2 months away. It's always just 2 months away.
Yeah, so I guess the front end, the WordPress is almost done. We're almost there. And then it's just more, we are spending a lot of time doing testing on
we want to make sure that it works well.
So at the moment, everyone can just keep using the DSR Plus algorithm is what we would sort of refer to. But the DSR 3 is coming. It's just taking a bit more time.
Yeah, and we plan to make a lot of enhancements to that website over coming years, even once we've launched.
All right, so good Q&A. I'm looking forward to doing more.
Yeah, keep them coming. And if this is the sort of stuff that is of interest to you, give us some feedback, give us a comment, click on like. If you're interested in getting more, then you can subscribe. And if there's any of this that you think might be helpful for someone else, there's a share link to make that easier for you.
Yeah, and send your questions through. Like we like sitting down, and we really enjoy our podcast days. And it's really just to provide the best value and our thoughts, and hopefully backed by data and experience. So everyone subscribe, like, share to the world, and thanks for tuning in. See you in our next episode. Bye for now, and take care.